Now we will deal with venture capital. Now, venture capital is a Now we will deal with venture capital. Now, venture capital is a financial capital which is provided to early stage, high growth potential startup companies, that is, equity finance for rapidly growing private companies. The finance may be required for startup, expansion, or purchase of new companies. Relatively high risk is compensated by the possibility of high return. A venture capitalist is a person or investment firm that makes venture investments, and these venture capitalists are expected to bring managerial and technical expertise as well as capital to their investment. A venture capital fund (VCF) refers to a pooled investment vehicle that primarily invests the financial capital of third-party investors in enterprises that are too risky for bank loans or capital markets. Example of VC companies are SBI Venture Capital Fund, Gujarat Venture Finance Limited, Bloom Ventures, etc. Now we deal with the features of venture capital. Number 1. Objective. The basic objective of a venture capitalist is to make a capital gain on equity investment at the time of exit and regular return on debt financing. Second, new ideas and technology. VC is available only for commercialization of new ideas or new technologies and not for enterprises which are engaged in trading, financial services, research and development. Third, liquidity. Liquidity of the VC investment depends on the success of the venture business. Fourth, involvement of investment capitals. Unlike the other forms of lending, venture capitalists continuously involved in the client's business. They either provide loans or their managerial expertise or any other support that can be beneficial to the business. Fifth, mode of investment. Venture capital is basically equity financing method. The finance can also be in the form of loan or convertible debt, which can provide the venture capital a running yield. Sixth, hands-on approach. Though venture capitalists do not interfere or take controlling interest in the firms, they are always available to provide business skills or other such assistance. Next, high risk, high return. Generally, the venture capitalists fund high risk projects. These high risk projects give them scope to demand high returns at the time of exiting the venture. Next, small and medium firms. Venture capital beneficiaries are generally modernized technology-oriented, new small and medium-sized companies. These venture capitalists fund these firms till they become large and stable enough to raise funds from the conventional financial markets. Now we will discuss the stages of venture capital financing. Number 1. Early stage capital. A. Seed financing stage. At this stage, the product or service is not fully developed. It usually exists as an immature idea with an incomplete informal management. The feasibility study has also not yet been carried out to see whether the project is technologically and commercially feasible. Generally, at this stage, the formal lending institutions are reluctant to lend, thus the entrepreneur is dependent on his family and friends or any other private investors for funding. The funds received are used to develop the idea into reality in order to prove its feasibility. It is also used towards research expenses. B. Startup capital. Startup capital generally deals with funds needed to start a business. At this stage, the company and its team of managers has already been formed. Venture capital is sought for building a team and completion of a business plan. Thereby, the product can be developed. Usually getting venture capital funds at this stage is a tough task. C. First stage capital. Financing. At this stage, the company is launched, sales start picking up. The funding at this stage is used to increase sales, to increase productivity and build proper infrastructure and distribution channels. This is the stage when the company is around 2 to 3 years old and the venture capitalists start showing interest in getting involved in the business. The next type of investment is called expansion capital, as it is a capital which is needed by the business after operations have begun. 1. Second stage financing, 2nd, third stage financing, and 3rd, bridge capital or mezzanine financing. Now, second stage financing. this stage, sales have increased to a great extent. The company's products are in high demand, hence, there is bound to be debtors as well as huge inventory costs. The company needs venture capital to increase marketing expenses and penetrate into new markets. B. Third stage financing. Sales are at an all-time high. The company's products and services have made an impact in the market. Funds at this stage are used to increase plant capacity, boost marketing efforts, and increase the working capital. And to expand in the third stage, the profits have already started coming in. Now, because the business needs more capital for not only research and development but also for expansion. C. Bridge capital or mezzanine financing. The company has proved to be successful, but there is yet time to go public. Mezzanine or bridge financing is thus a short-term fund used to prepare a company for the launch of its IPO. Third, latter stage financing. It is at this stage that the venture capitalists decide that it is now time for their planned exit from the venture. 1. Buyouts. There are two categories. 1. Management buyouts and second, management buyouts. In management buyouts, venture capitalists provide funds to enable the current investors to acquire a current business. In management buying, it is provided with an intention to enable a third party, that is an outside group of businessmen, to acquire the operating business. Next, turnarounds. This involves acquiring control over a sick company. This kind of buyout is only feasible if there are adequate funds and efficient management available to turn around the company into a profitable venture. Now we will deal with the mechanisms of exit from the venture. The various types of disinvestments that are associated with exits from venture capital funding are: number 1, disinvestment of equity / quasi-equity investments. These are subclassified into A. Initial public offering, 2. Sale of shares to entrepreneurs / employees, C. Sale to another company, D. Selling to a new investor, and E. Liquidation. Second, exit of debt instruments. A. Initial public offerings, that is IPO. This is the most common exit strategy that venture capitalists adopt. This has various benefits such as eligibility of stock exchange, listing, higher price of security, better image and credibility. But it is subject to extensive reporting and paperwork. B. Sale of shares to entrepreneurs / employees. The venture capitalists can sell the shares to the entrepreneurs who had initiated the venture. Alternatively, the shares might also be sold to the employees through the employee stock ownership plan, that is ESOP. C. Sale to another company. The entire company can be sold to another company through the methods of buying or buyouts. D. Sale to new investor / venture capitalist. The venture capitalist also has the option of selling it to another investor who may be in the same line of business. They may also sell off their stake to another venture capital organization having the same business objectives. E. Liquidation. The venture capitalist is forced to liquidate the unit in case it is not working well. It is an involuntary strategy. It may occur due to various uncontrollable factors such as changes in technology, change in customer preference, conditions of the economy, etc. Exit of debt instruments. In case of a normal loan, exit is possible at the end of the payment of the loan. But in case if it has been predetermined at the time of examination, the loan could be converted into equity shares, full or partly. Next, venture capital investment process. Number 1. Study of VC's details. In-depth analysis is done on a project. Initial screening is carried out to satisfy the venture capitalist of certain aspects of the project. These include competitive aspects of the product or service outlook of the target market, abilities of the management team, availability of other sources of funding, expected returns, time and resources required from the venture capital firm, etc. Second, submission of business plan. The business plan is a document that outlines the management team, product marketing plan, capital costs, and means of financing and profitability statements. If the plan is clear, then the VC is called for the detailed business plan from the entrepreneur. The business plan is the main tool with the help of which VC would make up its mind. Third, scrutiny of business plan. Thus, the entrepreneur should present clarity of thinking about the business in the plan, as surprises can be great for parties but could be potentially fatal for businesses. Fourth, preliminary meeting. The initial meeting provides an opportunity for the venture capitalist to meet with the entrepreneur and key members of the management team to review the business plan and conduct initial due diligence on the project. It is an important time for the management team to demonstrate their understanding of their business and ability to achieve the strategies outlined in the plan. Fifth, negotiating instruments. This involves an agreement between the venture capitalist and management, often called Memorandum of Understanding (MOU). The venture capitalist will then proceed to study the viability of the market to estimate its potential. Sixth, approval. The process involves due diligence and disclosure of all relevant business information. Final terms can be negotiated. An investment proposal is typically submitted to the venture capital fund's board of directors. If approved, legal documents are prepared. Thank you.